Welcome to the deep dive. Today we're slicing into a true American staple. I mean, a company that's been putting bread on the table literally for over a century. We're talking about Flowers Foods, ticker FLOW. You probably know them for their huge, ubiquitous brands like Nature's Own or Wonder Bread, or maybe the one you see everywhere now, sKillerBread. It's a classic consumer staple, right? You buy bread whether the economy is good or, well, not so good.
And for decades, that was just about the best place you could put your money, selling basic things like bread. Since its IPO, its initial public offering back in 1968, Flowers Foods has delivered just an astonishing total return.
What was the number?
40,000%.
Wow.
Yeah, 40,000%. That number it's magnificent. It
Right.
really speaks to the power of, relentless scale, efficiency, and just that stable demand in a market for something people absolutely need.
And that is exactly where we have to start. A 40,000% historical return. You would think a company that successful selling something so essential would be a market darling today. But its stock performance lately has looked, frankly, like a stale, crumbled loaf. Investor anxiety is running extremely high.
It is.
And it seems to be driven by collapsing volume in its core categories and this really aggressive debt-fueled strategic pivot they're trying to pull off.
Well, our sources reveal this fascinating internal struggle, which is really the key to understanding all the turbulence right now. The traditional business model, the very core of Flowers Foods, is shrinking. It's under some intense secular pressure.
Right.
And this contraction has basically forced management to place a massive, nearly $800 million bet on the future.
The acquisition of Simple Mills.
Exactly, and it was funded almost entirely by debt.
Okay, so let's unpack this. Is Flowers Foods a hidden diamond in the rough, it ready to transform itself into some high-growth, consumer packaged goods powerhouse?
Right.
Or is it a classic value trap? It looks cheap for a very, very good reason. So for you, the listener, our mission today is to dissect their current business model, analyze this aggressive strategy of buying up high-growth health brands, and examine the brutal headwinds.
Everything from changing consumer tastes to those high-profile weight loss drugs.
Yeah, and we're going to critically evaluate the balance sheet and, of course, the all-important dividend profile. Let's jump in with the foundation of the company.
Okay, so Flowers Foods, its roots go back over 100 years, Thomasville, Georgia. It started as a simple family bakery. And, while that family history is a great story, the real investment story starts after they went public in '68,
Right.
because that's when their primary mode of expansion became acquisition, just buying and integrating regional and specialized bakeries one after another.
And they have been utterly relentless about
Oh,
it.
completely.
The number I saw was over 110 acquisitions just between 1968 and 2020.
That's right. And this constant integration of all these smaller regional players is what built the Flowers Foods we see today.
The second largest bakery in the U.S.
Yep, right behind the market leader, Grupo Bimbo.
So this relentless scaling has created what you'd call a logistical powerhouse.
It really has. I mean, this isn't just a big regional company. They're operating something like 44, 45 industrial bakeries. And they manage this massive network of 640 distribution centers all across the country.
Let's put that scale into perspective for you, the listener. When you walk down the bread aisle in the grocery store,
About 30% of that shelf space, a third of it, belongs to Flowers Foods.
that is a powerful market position.
It's huge, especially in a core staple category. That 40,000% return wasn't about, some wild innovation. It was about compounding market share through scale and distribution efficiency.
Okay, and this whole operation runs on two main streams of revenue. And the difference between these two is, it's everything when we start talking about margins and profitability. So walk us through that sales mix.
Sure. So about 64% of their sales are what they call branded sales. These are the products with the official logos you recognize. Nature's Own, Wonder Bread, sKillerBread.
And these are the higher margin products because they lean on that brand loyalty.
Exactly. That brand loyalty lets them control the pricing. They have higher margins because Flowers Foods sets the price, the manufacturer's suggested retail price. The company benefits directly from that brand equity and, the pricing power that comes with it.
Okay, so that's about 2/3 of the business. What's the other third?
The remaining 36% falls into private label or contract manufacturing.
So that's where they're baking for a third party, maybe a big grocery chain or a hospital, a restaurant.
Precisely. It's when a third party who doesn't have their own manufacturing contracts out the baking. The margins here are, well, they're inherently lower because the pricing leverage is with the customer, not with Flowers Foods.
But I imagine that volume is really important for their efficiency.
It's critical. That private label volume ensures their 45 massive bakeries are always running close to full capacity. This low margin volume provides operational stability, it maximizes their efficiency, and it minimizes the cost per unit across the entire system.
That efficiency of scale, though, it brings us right to the customer concentration issue. When you operate at this size in consumer staples, you're naturally going to rely on a few huge retail partners.
And that reliance is substantial. For fiscal year 2024, their top 10 customers. They accounted for a remarkable 56.7% of total sales.
More than half their business from 10 customers.
But we need to zoom in even further on their single largest customer, Walmart and Sam's Club.
Okay, what's that percentage?
Walmart and Sam's Club accounted for 22.4% of Flowers' total sales.
A quarter of their business? That kind of concentration is, well, it's terrifying for some investors because of the power imbalance that it implies.
And it really cuts both ways. Walmart has just been relentlessly increasing its market share. They now command something like 21% of the total U.S. grocery market. So for Flowers Foods, this dependency offers a massive, consistent source of volume. They have a guaranteed buyer for a quarter of their product.
Which is a huge operational advantage for planning and production.
A tremendous advantage, yeah. For forecasting, for production planning.
But the flip side is obvious. Walmart's size gives them incredible leverage to demand, margin concessions.
Without a doubt. Walmart uses that leverage to demand better pricing, better inventory terms, more promotional support from all its suppliers. So Flowers Foods, because of this reliance, is perpetually under pricing pressure in that 1/5 of its business.
So managing that relationship, balancing the volume against the pricing risk, it's this constant strategic challenge that just puts a cap on their overall margin potential in that legacy business.
It's an unavoidable daily reality for them.
So if the core traditional bread business is facing all this pressure and they're beholden to these huge customers on pricing, what's the real economic moat here? I mean, what stops a competitor from just making a better loaf and undercutting them?
Well, the arguments for a real economic moat, they basically boil down to two core elements. First is the established equity of their best-in-class, recognizable brands.
Right.
That loyalty factor that drives the premium pricing, especially in their growing segments like Dave's Killer Bread, that brand equity is real capital.
And the second argument is that gargantuan logistical infrastructure we're just talking about.
That is the truly insurmountable barrier. The logistics, the sheer economies of scale, the distribution network.
Okay.
It's almost impossible for a startup to replicate.
You can't just build that overnight.
No way. We are talking about the capital efficiency it takes to operate 45 facilities and 640 distribution centers all at the same time. A smaller, more innovative player, even if their product is genuinely better, can never match Flowers Foods' capital efficiency or their low logistics cost per unit when they try to distribute nationwide.
So that scale creates a powerful, defensible logistics moat.
It really does.
And this whole structure, it naturally dictates their strategy. It becomes about operational optimization versus just pure growth. They have to be really smart about where they put their capital.
And the strategy is now very sharply defined. They allocate the lion's share of resources to the growing brands, like Dave's Killer Bread and, of course, the new acquisition, Simple Mills.
And for the mature, legacy brands like Wonder Bread.
The goal there is just to maintain key performance indicators, keep them running efficiently, maximize the cash flow they generate, and this is key, avoid wasting money on big, ambitious marketing efforts to expand growth in segments that have already hit their addressable market limit.
So if a legacy brand has basically peaked, you just maintain it like an asset for cash flow generation.
Exactly.
And you redirect all that capital toward the brands that can actually expand market share in these new growing categories.
That's the playbook.
That logic perfectly sets us up for the next section.
Yeah.
Their really aggressive strategic pivot through M&A.
Right, because the ability to execute M&A is just baked into the company's DNA, their operational philosophy. They've mastered the blueprint for inorganic growth. And it's not just about acquiring companies, it's about acquiring these niche players and then successfully scaling them into mainstream powerhouses using that massive distribution network we talked about.
And we have two incredible success stories that really form the basis of the company's belief in this M&A strategy. Dave's Killer Bread, or DKB, is the obvious one to start with.
DKB, which they acquired in 2015. Since that acquisition, it has grown at an eye-popping 30% compound annual growth rate
30%.
for 9 years. When you hear about CPG growth, that's consumer packaged goods, that level of sustained double-digit growth is highly, highly unusual for a staple product like bread.
And DKB is now the #1 organic bread in the U.S.
By a mile, it commands a staggering 74% share of the entire organic fresh bread market.
74%. Wow. And this success story is replicated in the gluten-free space with Canyon Bakehouse.
Yep, Canyon Bakehouse, acquired in 2018. It's the #1 gluten-free bread brand, owns about 37% of that market. And since they bought it, it has also posted an impressive 30% CAGR.
So these high-margin, health-conscious categories, gluten-free, organic, better for you, they're the true lifeline for Flowers Foods right now.
They absolutely are.
They're growing at double-digit rates, which, as you said, is this massive contrast to the, 1 to 2% expected growth rate in the traditional bread industry.
It's night and day. And this brings us to the biggest, most defining decision management has made recently. That $795 million bet they placed in January 2025.
The acquisition of Simple Mills.
The acquisition of Simple Mills. And it was funded entirely with senior notes, which is debt. And it signals a definitive, company-altering pivot away from just bread.
And Simple Mills is all about those higher growth, higher margin snacking categories. Crackers, cookies, snack bars, baking mixes. This feels like a very deliberate attempt to graduate from being just a bread company.
The strategic rationale is crystal clear. Simple Mills targets that highly profitable health and wellness trend. Organic, natural, non-artificial ingredients. It aligns perfectly with the modern aspirational consumer.
And Simple Mills already had phenomenal historical performance.
It did. It was growing at a 28% CAGR between 2019 and 2024. And what's really aggressive is that management is projecting a continued 28% growth rate for the next 5 years post-acquisition.
So what's fascinating here is how Flowers Foods is planning to leverage its biggest strength, that distribution and scale, to immediately accelerate the trajectory of Simple Mills.
Exactly. They're taking a strong, innovative brand and immediately plugging it into their massive, efficient logistics network. It shows that management is actively trying to shape the company into a next-generation CPG focused on these healthy pantry staples rather than just, reacting to the decline of traditional loaf bread.
Okay, but we focused on these incredible successes like DKB and Canyon. But Flowers has completed, over 110 acquisitions? We can't ignore the high failure rate that's just inherent in that kind of activity. Which acquisitions didn't work out, and what did those failures maybe teach management about integration risk?
It's an essential and challenging question. The M&A graveyard is always large when you make 110 acquisitions. Historically, a lot of their early regional bakery acquisitions, they proved to be really inefficient.
Why was that?
Because their localized distribution models were just fundamentally incompatible with FLOW's centralized, highly efficient system. They often ended up with duplicated overhead, duplicated distribution routes, just a mess.
So the lesson seems to be, focus on innovative brands first, and then integrate those brands with the FLOW logistics system, rather than just acquiring regional capacity for the sake of it.
That's precisely the lesson they learned. Acquiring a regional brand is only successful if you can immediately replace its legacy, inefficient logistics with the FLOW system. And the Simple Mills deal, it adheres to this lesson perfectly. It's a national, innovative brand with phenomenal growth, and FLOW is confident they can immediately enhance its trajectory by leveraging that distribution network. That's what makes for a successful integration.
And beyond these big acquisitions, we're seeing some strong internal innovation that's aggressively targeting these little pockets of growth, even within the old brands.
They're really focused on differentiated offerings. Look at Nature's Own, their flagship brand. They successfully introduced keto offerings and small loaves. The move into the keto subcategory was really successful. They captured the #1 market share position there pretty quickly.
So they're actively seeking out the smaller, faster-growing niches within the overall shrinking pie.
They have to. And they're expanding their acquisition successes, like DKB, far beyond just the bread aisle itself.
Right.
DKB is really the blueprint for brand extension. It's expanded into snack bites, snack bars, protein bars. And their upcoming 2026 innovation slate is particularly robust. They're talking about a new DKB breakfast bars platform and 10 new SKUs of bars and bites.
So they're taking that established trust in the protein-packed organic bread category and transferring that premium equity into the adjacent higher-margin snacking category.
It's a very smart move. And even Wonder Bread, the legendary brand with 97% consumer awareness, is being leveraged strategically.
You can't just let that brand recognition sit there.
Exactly. They're leveraging that massive consumer trust to drive growth in adjacent product categories where the traditional soft loaf is declining. Wonder is seeing 7% unit growth in categories like sandwich buns and rolls.
Okay.
They're also expanding into breakfast items like English muffins and bagels and even cake.
So how is that doing?
The fact that Wonder grew its cake sales by 1% in Q3 2025, even though the overall category declined by 5%, it really validates management's decision to maximize the cash flow potential of that legacy asset.
And finally, that focus on small loaves seems like a great example of being responsive to both economic stress and changing household sizes.
This is a perfect example of Flowers Foods trying to straddle two very different consumer demands. The small loaves address the value-conscious consumer because they're cheaper, and also smaller households who are worried about food waste.
And the demand is there.
Oh, demand for this subcategory shot up 85% in units in Q3 2025. And Flowers quickly captured the #2 market share position. The expectation is that even though the traditional bread industry growth is only, 1-2%, these healthy, better-for-you, and value categories are still offering these crucial double-digit growth opportunities that can offset the core decline.
Okay, so the strategy is aggressive, the M&A pipeline is firing, innovation is targeted, but all these sophisticated strategies are a direct response to a core weakness. So now we have to face the cold, hard facts, the headwinds, the anxiety, and the declining core demand that is driving this entire transformation.
Right. The structural challenge facing Flowers Foods is, well, it's existential. The middle market is being squeezed from both sides. Their core traditional business, the soft loaf, the sweet baked goods, it faces these serious secular headwinds that are undermining profitability and generating a lot of anxiety in the market.
And we saw some pretty alarming figures in those Q3 2025 results that really illustrate this rapid erosion.
The erosion is steep. Traditional loaf units, so the volume of soft bread sold, declined 6.3% in Q3 2025.
6.3%.
And to put that in context, this is far worse than the overall food category decline, which was 1.8%. And it's worse than the overall bread category unit decline of 2.9% in the quarter.
So the market isn't just flat. It's actively fleeing the specific products that FLOW historically dominated.
Yeah. Exactly. And on top of that, their sweet baked goods portfolio, including brands like Mrs. Freshley's and Tasty Cake, showed what management diplomatically called significant weakness.
And CEO Riles McMullian, he cited 3 primary culprits driving this erosion. The first, the challenging economic environment that always pressures basic goods. But the second and third culprits are, well, they're truly long-term existential threats.
The second one is what seems to be an irreversible trend toward healthier eating. Avoiding processed foods, reducing carbohydrate intake, this is accelerating. And consumers are actively moving towards organic, gluten-free, or high-protein alternatives.
Which is exactly why Flowers is making this strategic move with Simple Mills and DKB.
Precisely. Their legacy brands are the structural victims of this major dietary shift.
And the third culprit is what is truly spooking the market and forcing a reevaluation of the entire food industry: the rise of GLP-1 weight loss drugs.
This is where we need to spend some significant time because the impact of these drugs, Ozempic, Wegovy, and the others, it's a fundamental structural change, not a passing fad.
So how do they work exactly?
GLP-1 drugs work by mimicking a hormone that regulates your appetite, and crucially, it slows down the digestive process. So users feel full faster and for dramatically longer periods of time.
Okay, so what does that mean for a company whose entire business model is built on high-volume consumption of staples?
It means a quantifiable reduction in consumption volume. The early industry models are startling. They suggest that GLP-1 users can reduce their overall calorie intake by 20 to 30%.
20 to 30%.
Yeah. So if millions of people migrate to these drugs, the entire addressable market for calorie-dense staples like soft bread and sweet baked goods, it just shrinks overnight. We're talking about market compression that no marketing campaign can fix.
So management isn't just dealing with a new competitor or inflation. They're dealing with a medical intervention that literally shrinks the total consumer universe for their legacy products.
Exactly. The entire industry is scrambling to model this risk right now. Flowers is responding by, increasing protein content in DKB and moving into those small loaves less volume per purchase. But the core anxiety remains. If unit sales of traditional loaf are already declining 6.3%, how much further is that going to fall as GLP-1 usage becomes more and more widespread?
This drug class just puts a hard, permanent cap on the ultimate size and profitability of that legacy business.
It does. And compounding these secular headwinds are some fierce competitive pressures,
Yeah.
especially from the rise of store brands.
Private label.
Private label or store brands are the ultimate value play, and they are thriving. They currently make up about 25% of the market share. And this pressure gets much more intense during inflationary periods. The longer inflation persists, the more consumers flock to discounted options, like Walmart's Great Value Bread.
Which sits right next to Flowers branded products on the shelf at a discount.
Right. And this forces Flowers Foods to increase their promotional activity, to use more coupons, which directly erodes the pricing leverage and the margin of their branded products in those legacy categories.
So they're caught in the middle. They're losing the premium consumer to health trends, and they're losing the value consumer to store brands. And now, by expanding into the cookie and cracker category with Simple Mills, they are voluntarily entering markets that are dominated by absolute giants.
And that's the critical risk of this strategic pivot. They are now going head-to-head with multi-billion-dollar behemoths like Mondelez, Kellanova, Conagra.
Companies that have perfected the snack business.
Absolutely. They have perfected snack distribution, manufacturing, and marketing in a way that Flowers Foods has very limited prior experience with outside of their bread distribution ecosystem. The competition is incredibly intense, and the price of failure in this new arena is very high, especially given that debt load.
And speaking of jet, the market is also very concerned about their reliance on inorganic growth.
Oh, absolutely. The perception is that all their revenue growth is inorganic, that they are way too dependent on acquisitions to mask the decline in their core business.
Which is why the stock trades at such a discount.
It is. The market is essentially saying, we don't trust you to grow without continually buying new companies, and this just amplifies the integration risk. If Simple Mills fails to meet its aggressive growth projections, or if the integration costs spiral, which we are already seeing some early signs of, the entire strategy fails, and that leverage becomes a catastrophic problem.
So the anxiety is palpable. But we do need to offer a counterpoint based on their history. FLOW sells consumer staples. Historically, this business has shown remarkable recession resistance.
And that resilience is a strong counterargument. If we look back at the Great Recession of 2009 and 2010, when most industries declined significantly, Flowers Foods sales remained flat or even slightly up year over year.
And the same in 2020.
Likewise, in 2020, amidst all the global disruption, they actually posted growth. So while the secular decline is a serious long-term issue, the company is remarkably resilient against sudden economic shocks because, well, ultimately, people still need to eat.
And that resilience provides the robust cash flow they're using to fund this high-risk pivot.
It's crucial.
That strong cash flow is crucial, but the Simple Mills debt fundamentally changes the risk profile. So let's turn now to the numbers and see if the market is accurately pricing this highly leveraged transition. Let's turn to the numbers. We see some real valuation anomalies when we look at the core financials of Flowers Foods.
We absolutely do. Let's just compare their size against their sales. Their current market capitalization is hovering around, $3.97 billion versus their fiscal year 2024 revenue of $5.1 billion.
So their total revenue is actually larger than their market cap. And this results in an exceptionally low price to sales, or PS ratio, of 0.78.
And this is highly unusual for a major publicly traded consumer goods company. A PS ratio below 1 suggests the market perceives some fundamental problems. It means you can buy $1 of their sales for just 78 cents. For FLOW, the weak growth and the outlook are clearly factors, but this ratio tells us the stock is historically cheap compared to the volume of business they do. It just signals massive market pessimism.
Okay, now let's look at their valuation based on future earnings, the forward price to earnings, or PE ratio. It's currently around 16.
And the context here is vital. Flowers Foods' 20-year historical average PE ratio is a towering 26.14.
26.
So trading at a PE of 16 represents a massive discount to its own norm. Historically, that average was so high because the market paid a premium for the stability and the reliable, modest growth of the staple business.
So the fact that the PE has fallen so dramatically, it confirms that the market is heavily discounting the stock price, specifically because of the debt risk and the structural decline of that core business.
The fear is directly related to the debt situation. It is the single biggest financial risk they have taken on.
The defining factor of this investment story.
It is. That $795 million Simple Mills acquisition was funded entirely with senior notes, a form of debt. Their long-term debt increased from $1.02 billion at the end of 2024 to $1.78 billion as of Q3 2025.
And pro forma net debt.
Pro forma net debt, which accounts for the cash they have on hand, swelled to approximately $1.9 billion.
And this jump in debt directly impacted their leverage ratio, their debt relative to adjusted EBITDA.
It did. The deal pushed their leverage ratio to approximately 3.5 times adjusted EBITDA, and this immediately prompted S&P Global Ratings to take action.
They revised the outlook.
They revised the debt outlook from stable to negative, and they explicitly cited increased financial risk. Management's goal is to keep that ratio below 3, and hitting 3.5 means they have very little breathing room.
So they have to focus on deleveraging rapidly.
They must, or they risk a full credit downgrade, which would significantly increase their future borrowing costs and threaten the entire strategic pivot.
The clock is ticking. Let's dig into the hard data from the Q3 2025 financial results, which give us the first real look at the costs of this pivot.
Okay, so net sales increased 3.0% to $1.227 billion for the quarter. But here's the crucial detail. The entire sales growth was inorganic. It was due to the Simple Mills acquisition, contributing 5.9%.
Wait, so their overall volume declined 0.6% in Q3, and their pricing mix also declined 2.3%. Yeah. So if you strip out Simple Mills, their net sales are actually expected to decline for the full year 2025, somewhere between 0.4% and 1.4%.
That is the core takeaway. The legacy company is actively shrinking outside of its M&A efforts. Simple Mills contributed $70.7 million in net sales, but it immediately hit their profitability. Simple Mills generated a net loss of $2 million and contributed a diluted loss of 1 cent per share in Q3 2025.
And this contributed to a significant margin squeeze across the board, didn't it?
It did. Adjusted EBITDA decreased by 11.4% to $118.1 million. And crucially, the gross margin decreased by a substantial 190 basis points, and management clearly linked this margin pressure directly to the Simple Mills acquisition.
Okay, explain the mechanism behind that margin squeeze, particularly Simple Mills' co-manufacturing model.
So Simple Mills is currently a 100% co-manufactured product. This means Flowers Foods doesn't bake the crackers or snacks in-house. They pay an outside third-party manufacturer to make the product for them.
Which is always a higher cost process.
By definition, it's a higher cost process than producing goods in your own efficient facilities because you're paying the manufacturer's margin. So therefore, the Simple Mills products temporarily carry a higher cost of goods sold, which dilutes FLOW's consolidated gross margin until they can integrate that production into their own network.
So the margin pressure is a temporary integration cost, not a permanent structural issue with Simple Mills itself.
Yeah.
What's the expected timeline for margin stabilization?
Management expects this pressure to persist until they lack the acquisition date, which is February 2026. That's the timeline for when they hope to have streamlined the supply chain and potentially brought some of that co-manufacturing in-house, which would significantly improve the growth margin profile of the new brand and justify the long-term bet.
They also saw selling, distribution, and administrative or SDA expenses increased slightly.
Yes, and that was primarily due to higher workforce-related costs, general wage inflation and the expensive mandatory transition to an employee-based distribution model in California, which is necessary but costly.
So given the shrinking core, the massive debt load, and the near-term margin dilution, management narrowed their full-year guidance for 2025. What was the impact on earnings?
They narrowed the adjusted EPS to a range of $1.02 to $1.08. And importantly, they specifically quantified the cost of this pivot. Simple Mills is expected to be dilutive in its first year, reducing adjusted EPS by between 7 and 8 cents.
So they're consciously accepting lower near-term profitability to invest in long-term growth.
That's the trade.
The picture is volatile, but for many investors, the only reason to hold on through all this is the dividend.
And the dividend profile is the core attraction and the stabilization mechanism for patient investors right now. Flowers Foods currently offers a high dividend yield of 5.1% with a payout of 96 cents per share. That yield is significant in today's interest rate environment.
Okay, but we have to conduct 2 sustainability checks on that dividend. First, the accounting check, based on earnings per share, or EPS.
The EPS payout ratio is 81.3%. This is considered a small yellow flag. The preferred threshold is usually 80% or below. If reported earnings decline further, which they are expected to do in the short term because of the Simple Mills dilution, that ratio could climb into the dangerous zone.
But the cash flow check is the gold standard for dividend safety. What does the free cash flow, or FCF, payout ratio tell us?
This is where the dividend looks safe for now. Their FCF payout ratio is significantly better at 72.7%. This FCF metric confirms that the dividend is well covered by the cash generated from operations, especially since their FCF per share grew by an impressive 28.15% year over year.
So the cash flow from that stable, recession-resistant legacy business is highly robust.
It is, and it's supporting the dividend while they execute this transformation.
And the most powerful signal of confidence was the board's decision back in May of 2025.
The timing there was crucial and intentional. After reporting weak Q1 results and after announcing they were taking on $795 million in debt, the board still approved a 3.1% dividend increase.
Which is a bold move.
It is. And CEO McMullian explicitly stated that this move reflects the board's confidence in Flowers' strategy and ability to enhance shareholder value over time. They were signaling to the market that they believe the cash flow can service the debt and sustain the dividend increase.
And this confidence is reinforced by insider buying.
It is. Insiders have been actively buying shares recently, which further signifies their belief that the stock is undervalued and that the short-term pain, the debt, the dilution, the shrinking core, is a necessary stepping stone toward long-term growth in those high-margin categories.
Okay, so let's look at the path forward. How are they managing this transition and all this risk?
Well, the strategic blueprint for navigating these complex, volatile headwinds is dubbed the Fresh Forward Flowers strategy. It's championed by CEO Riles McMullian. It's a multi-pronged recovery plan focusing on the factors that are entirely within the company's control.
And this plan rests on 4 strategic priorities: developing their team, focusing on brands, prioritizing margins, and pursuing smart M&A. This reflects a commitment to stabilizing the cash cow while aggressively investing in the future.
And prioritizing margins means relentless efficiency and cost optimization. This includes painful but necessary decisions, like the closure of an underperforming bakery in Q1 2025. And streamlining their vast transportation network to reduce production scrap and improve logistics costs all essential steps to fight back against the pricing pressure from giants like Walmart.
They're also investing heavily in their technology infrastructure, specifically a large-scale ERP system upgrade. This is a massive internal project.
It is. ERP stands for Enterprise Resource Planning. This is the critical software system that integrates all aspects of a company's operations, from manufacturing and supply chain to finance and HR. For a company with 45 bakeries and 640 distribution centers, a fragmented IT system is a massive source of inefficiency and cost. Upgrading the ERP is vital for achieving the margin improvements they so desperately need.
But implementing an ERP system for a company this size carries huge operational risk.
It does. I mean, if the system fails during implementation, it can cripple your operations.
Yeah.
This is why management is proceeding pretty prudently. They're planning to have 10 bakeries live with the new system by the end of Q4 2025.
Okay.
They have also reduced the related capital expenditure expectations for this project. This signals 2 things: caution to minimize operational disruption and a necessary focus on capital efficiency given the new $795 million debt load.
And adding another layer of transition risk is the change in the executive team. The departure of their long-tenured CFO, Steve Kinsey, after 18 years at the end of 2025 is significant.
Kinsey guided the company through numerous acquisitions and market cycles. His replacement, Anthony Scaglione, joins in January 2026. And Scaglione is stepping into the financial driver's seat at the most complex time in the company's recent history. He'll be responsible for navigating the financial strategy through this landscape and, critically, leading the entire deleveraging process following the Simple Mills acquisition.
So this change in financial leadership adds a definite layer of execution risk during a really high-stakes pivot.
It does.
So let's bring all these variables together into the investment trade-off. First, the bear case, the argument that this stock is a value trap.
The bear case is based on fundamental decay. The legacy brands are declining steeply. Traditional loaf units fell over 6%. The company took on massive high leverage, that's $795 million in debt, and is facing significant integration risk by entering new, hyper-competitive snack markets. If the Simple Mills integration fails or debt service becomes too burdensome, the dividend is threatened, and the stock is trading cheaply for a very good reason. The bear believes the secular decline will accelerate and overwhelm the small growth from the M&A.
Okay, on the other side, the bull case. This argues that it's an opportunity to buy a quality company undergoing a necessary transformation at a steep discount.
The bull case sees astute management using their robust, recession-resistant cash flow from the stable old business to fund a decisive pivot into the fastest-growing, highest-margin food segments. The high-yield 5.1% dividend is currently well covered by the strong free cash flow, and management confidence is tangible through that dividend hike and the insider buying.
So this view believes the short-term pain of higher debt and dilution is a necessary trade for creating a fundamentally healthier, more resilient CPG company years down the line.
That's the bull case.
The immediate priority for management, which will determine who is right, is clear. Deleveraging and hitting those Simple Mills integration targets.
Absolutely. The immediate goal is twofold: maintain an investment-grade rating and return to a more normalized leverage ratio, dropping that 3.5x leverage back down to below 3x before they even think about the next large-scale M&A.
And the next 18 to 24 months are the critical timeline.
That's it. They must successfully digest Simple Mills, stabilize margins, and aggressively pay down the balance sheet debt. This period will be the ultimate test of the Fresh Forward Flowers strategy execution.
Okay, so if the bull case holds even partially true, the current depressed stock price seems to offer significant potential appreciation based on valuation metrics alone.
We see a huge discrepancy in the valuation models. The average Wall Street analyst target price sits around $21.33, which represents roughly 13% upside just from share appreciation. However, if you look at the dividend discount model, which values the stock based on the sustainability and conservative growth of that dividend stream, the implied valuation is much higher, around $33.28 per share.
That is a huge gap. If we take the consensus fair valuation, the middle ground often suggested is around $23.50.
Right. And even the most bearish analysts covering the stock believe it should be worth at least $20 per share, which confirms that, mathematically, anything below that target range is arguably undervalued. Value investors generally see anything around $18 or less as a good entry point. The market is pricing this stock based on the fear of the shrinking core, but the underlying cash flow and the future profitability of DKB and Simple Mills suggest a much higher intrinsic value.
Provided management executes this complex transition flawlessly.
That's the big if.
So the final verdict seems to be a company that is above average in terms of resilience and strategic vision. Let's call it a B-plus company. But its future growth prospects are modest overall. They're heavily dependent on the small but fast-growing health segments. It's an investment for the patient.
It truly is. This is a story of an incumbent trying to execute a massive turnaround while navigating these deep structural economic forces like GLP-1 drugs and inflation. The debt is the risk, the FCF is the stabilizer, and the pivot to Simple Mills is the potential reward.
We've looked at Flowers Foods from every angle, from the humble Wonder Bread aisle to the sophisticated financial engineering behind their new healthy snack empire. They're consciously trading short-term pain, the higher debt, the integration costs, the near-term earnings dilution, for the long-term potential of massive growth in the hottest segments of the food industry.
And if we connect this to the bigger picture, this transformation reflects a necessary high-stakes evolution in the consumer staples world. The market is consolidating around two extreme poles: extreme value, which is dominated by private label, and differentiated premium health, dominated by these high-growth brands like DKB and Simple Mills.
And the traditional, undifferentiated middle ground where Flowers Foods' legacy brands sit
Is rapidly disappearing.
So the immense challenge for management, then, is executing this transition without getting bogged down by the costs and infrastructure of the old business or crushed by the debt from the new one.
And that brings us to our final provocative thought for you to consider. We know the traditional bread category unit sales are declining, and traditional loaf is under severe pressure. Flowers Foods' strategy requires them to simultaneously cater to the premium, health-conscious consumer with Simple Mills and DKB, and target the highly value-seeking consumer with small loaves and promotional activity for their Nature's Own line.
Which raises an important question. Can a company successfully straddle two entirely different consumer demands, premium differentiation and low-cost value? Or is this multi-pronged approach ultimately destined to dilute their focus and prevent them from truly excelling in either hyper-competitive arena? It's a delicate balancing act, and the success of Flowers Foods over the next 2 years depends entirely on whether they can manage to be the master of both or the master of neither. A lot to chew on for this American staple under pressure. Thank you for joining us for the deep dive.